So today we're going to be learning a little bit more in depth about flood insurance and some tips and tricks to avoid closing delays. My name is Sarah Dotson and I'm with Prosper Insurance. And as a realtor, you used to not be required to get a CE of flood insurance, but that changed a few years ago, and there's a reason for that. In 2012, the Congress passed the Bigger Waters Insurance Reform Act, and it had a really big impact on real estate, on the industry, and on real estate values. I don't know how long all of you have been in the business, but maybe you've all been in a situation where something happened that tripped up a transaction or made someone not qualify for a loan due to the home being in a high-risk flood zone. Maybe the flood premium was too high and it was causing the buyer not to qualify, or it caused delays because you needed an elevation certificate. I know that's happened a lot across the board, and maybe that's happened to you guys. Today, what I want to do is not bore you with a whole bunch of forms and coverages. Instead, we're going to cover the basics and then also talk about things that you can do to be aware of and possibly prevent stumbling blocks as an agent if you get into a transaction, whether on a buying or listing side, if the home is in a high-risk flood zone and if there's a high premium, an expensive flood rate, what your options are. So covering the basics, a little bit of background on the flood insurance. Historically, private insurance companies did not cover flood risk due to the fact that flood damage is both generally catastrophic and hard to set rates for and hard to predict. So in 1968, the National Flood Insurance Program was created in order to provide coverage to people living within those floodplains, so the high-risk areas. And I want you to remember this: at a reasonable rate for all. We're going to circle back to that later, with risk-based premiums to help make people aware of and bear the cost of flood coverage. They came up with the definition of a flood, which is any sort of rising water. And the rising water needs to impact 2 or more properties and 2 acres of land to be considered a flood in FEMA's eyes. So if you live on a farm all by yourself and you experience a flood, but it doesn't impact another property, that's like a few miles up the road from you, then that would not be considered a flood in FEMA's eyes, which is really interesting. So it needs to impact 2 or more properties. So flood zones, I'm sure you all are, as realtors, are familiar with the flood zones and the letters. You have the preferred zones, X, B, and C. And when you see the X, B, and C, that means they're in a low risk flood zone, and a loan officer or mortgage company or mortgage banker would not require the buyer to get flood insurance. Now, one thing you never ever want to say as a realtor is, great news, you're not in a flood zone and you don't need flood insurance. A couple of reasons. Number one, there's no such thing as a no flood zone. Every property in the United States is in a flood zone, but you're either located in a low risk flood zone, so the X, B, and C, or a high risk flood zone, which is the A and V, and we'll get to that in a minute. So no such thing as a no flood zone. You have low risk and high risk. Number 2 is 1/3 of all flood claims happen in low risk zones. So much better language to use is, great news, you're in a low risk flood zone. You can get flood insurance if you want to. It's not going to be part of your loan or impact your monthly payment. That way you put the onus back onto the buyer to make that decision for themselves. Because what's going to happen, let's say 5 years from now, if you tell your buyer you're not in a flood zone and you don't need flood insurance, and then 5 years later, a big storm rolls through and they do experience a flood and they're not covered, who are they going to be upset with? the agent or the lender too that told them they didn't need to get flood insurance. So the preferred zones are the X, B, and C, and again, not required by a mortgage company in order to close, but they can get a preferred risk policy that offers low cost coverage to homeowners and even tenants of these buildings. And again, it's not going to impact your transaction. Right now, for the highest level of coverage for a preferred risk policy, on the building and the contents, which is $250,000 for the building and $100,000 for contents coverage, you can get a policy for right around $500 a year. If you lower those coverages, the premium goes down as well. So now we move into the high risk flood zones, which are also known as special flood hazard areas. These are your A and AE zones and V and VE zones. And flood coverage will be required in order to close on a loan if a buyer is, receiving lender financing on a property that's in a high risk zone, and it will have an impact on their debt to income ratio. Now, if they're buying cash, they don't have someone telling them that they need to get flood insurance. So technically they don't have to get flood insurance because they're not having the home financed, but I always recommend to have, if you guys work with cash buyers, make sure that you're looking and doing the flood zone determination for any properties they're purchasing, especially if they're planning to flip the home and sell it. There's a really good chance that the person they sell the home to on the back end will have a mortgage company or a loan officer and will have to get flood insurance. And if they can figure out if the home is in a high risk flood zone, and if there is an expensive premium associated with that flood zone, when they're doing the flipping and the renovations, there could also be some mitigation that they do as well, which could help combat high premiums. So just something to talk over with your cash buyers with. I always like to go off on that little tangent just to make sure that they are protected as well. Anyway, so back to the A and the V zones. A stands for accumulation and V stands for velocity. So the A is you're going to see in more than neighborhoody areas, and V and VE zones, those are the ones that are like a couple of blocks from the beach. So like Sandbridge, Outer Banks, that's where you will see those Vs. The homes in the A and AE zones, you want them to be on a crawl space. If they're sitting on a slab, it's going to be a really expensive policy. And I'll have an example of that in a minute. And then when you see a home that's in a V or a VE zone, you want those homes to be up on the pilings or stilts, much like you see down in Sandbridge and in the Outer Banks. And then I get this question all of the time. What is the difference between a 100-year floodplain and the 500-year floodplain, or the X500, it's also known as? So the 100-year floodplain is considered a high-risk zone, like flooding area. What that means is there is a 1% chance of experiencing a flood in any given year over the course of a 30-year mortgage. So that equals to a 26% chance of experiencing a flood during that 30 years. And then one thing to keep in mind is that the closer the home is to a flooding source, so a river, a stream, a pond, a bay, etc., the ocean, the higher the risk. So then it can increase from 26%, say that's like your AE zones in a neighborhood, you have a 26% chance, but then the closer you get to that water source, it could jump up to like 45%, all the way up to like 71% chance of experiencing a flood over the course of that 30-year mortgage, which is a higher percentage than experiencing a fire over the length of a 30-year mortgage, which I find very interesting. There's a higher risk of experiencing a flood. And then your 500-year floodplain, so that's the X500, so that would be considered the low risk zone. And that means there is a 0.2% chance of experiencing a flood in any given year over the course of that 30-year mortgage, which is, dramatically less. It's only 6% over the course of a 30-year mortgage. I say that, but it's also proven that a third of all flood claims happen in these low risk zones. So highly recommended to get the preferred risk flood insurance policy if you're in that X500 zone. So a couple more definitions. You have the base flood, which I just talked about. If you're in a high risk zone, that means FEMA thinks that you have a more than 1% chance on an annual basis for the water to come up to the footing of your house. If you're on a crawl space, then they think there's a 1% chance water will touch your house during that time period. Now, every home that's in a high risk flood zone has what is called the base flood elevation. And the base flood elevation is how high above sea level they think water will rise during a storm. So the base flood elevation on its own isn't what defines how expensive a flood policy is going to be. I'm going to do a little example here, and I hope that you guys can see me on the camera. So let's say your base flood elevation is sitting right here where my hand is. And for good math, here in Hampton Roads, you'll see the base flood elevation typically between 8 and 10 feet. So we're just going to call this 8 feet for good math. Now, so base flood elevation, 8 feet, where they think water will rise to in a storm. Now let's take your home and set it right here at 7.5 feet. That means you're in a high risk flood zone because your yard is sitting lower in your property than they think the water will go up to in a storm. Now, remember a minute ago when I said that homes in the AE flood zone, so this would be AE, if they're sitting on a slab, it's going to be an expensive policy. Well, now you can see why. It's sitting below where they think the water will rise to in a storm. And if the water does in fact, rise up to this 8 feet, where's the water going to go? It's going to go right through your home. So take this home that's, down at 7.5 feet and add 3 feet of crawl space. Well, now it's sitting, a few feet up above the base flood elevation. So it's still considered in a high risk flood zone, but that flood insurance premium is going to be a lot less expensive because now the water can flow through the crawl space and have less risk of causing damage to the actual home. So all of FEMA's rates go to how high above or below the base flood elevation to the living floor is. So the higher above the base flood elevation, the lower the premium, and vice versa. So below the base flood elevation, the higher the premium. Any questions so far? No? Okay. All right, so when the National Flood Insurance Program was created in 1968, its goal was to provide affordable insurance to help communities rebuild after flooding. And I mentioned this in when I first, opened up this presentation, saying that the goal was to provide flood insurance at a reasonable rate for everyone. And they did this by offering the premiums subsidized rates, which is less than sufficient to fund FEMA or the reserves for anticipated losses and expenses that can occur within the subsidized rate classes. In the years since, FEMA's programs, like FEMA's finances, have gone from bad to worse. And they lose about $1.4 billion each year. And their total debt exceeds $20 billion. And this is due to the catastrophic storms that we have experienced over the last 10 to 15 years. So think Hurricane Katrina, Hurricane Sandy, Harvey, Matthew, etc. And roughly 20% of all of the national flood insurance policies are calculated using these subsidized rates. Now, most of them are policies that were considered pre-firm, which means the homes were constructed before their community adopted its first flood insurance rate map and entered into the national flood insurance, or joined, I guess not entered, but joined the National Flood Insurance Program in these high-risk areas. So zones A and B. And the rates were subsidized by the government, and the policies could be rated without an elevation certificate. So if the home was built in 1940 and this property, their community joined the National Flood Insurance Program in 1970, that's considered pre-firm. Firm stands for Flood Insurance Rate Map. They would receive a subsidized rate and could be rated and get a policy without an elevation certificate. Now, if they had an elevation certificate, the rate would probably be lesser of the full risk and the subsidized rate as well. So if there was an elevation certificate available, you could turn one in and the premium could potentially even be lower because you have all the information listed on the elevation certificate on, how high above the base flood elevation the crawl space sits, etc. Because FEMA is $20 billion in debt, they have moved away from these subsidized rates and made some changes to the program. So now they are rating these homes with a full risk rate, or trying to. They're increasing the premiums, year over year over year to reach that full risk rate. And they've made some changes to the program because the long-term act is to eliminate subsidized rates. So now the properties, any property, no matter what year it was built, must be rated with a flood insurance. Must be rated with an elevation certificate. You can't get a quote without one, whether the home was built in 1940 or 2021, you have to have an elevation certificate. And so these are the dates. This was a little more relevant when you could rate without an elevation certificate. And so if a home was built, prior to 1968, those homes could definitely be rated without an elevation certificate. But if it was created, after in like the 70s or 80s, you could refer back to the city firm dates here, in which our cities here in Hampton Roads joined the National Flood Insurance Program. And so in Chesapeake, if the home was built in 1976, it used to be they could be rated without an elevation certificate because it was built a year before Chesapeake joined the National Flood Insurance Program. So I like to put this on here. I just think it's interesting to see the years that the cities in our area joined the National Flood Insurance Program. And again, for context, 1968 was the year that it was created. So Chesapeake joined 9 years later in 77. Hampton joined really quickly in 1971. Newport News 77. Norfolk 1979, which is insane to me because Norfolk floods so easily. Portsmouth 71, Poquoson 77, Suffolk 1990. Like that's, a long time after they joined. In 1988 in Yorktown, and then Virginia Beach in 1971. And then I also have one on here for Central Virginia because I do this presentation out there as well. So I wanted to put in a little slide for them. I'll leave it up for a second if you want to take a look. And now I'll move on. So in March of 2014, the Homeowner Flood Insurance Affordability Act was signed into law. And basically what this law does is help make the National Flood Insurance Program More financially stable by continuing to raise rates on those certain classes of property to reflect the true flood risk. So moving from that subsidized rate to a full risk rate. It can trigger rate changes for certain properties within a revised or updated map area to accurately reflect the flood risk. We've seen that happen a lot over the last several years here in Hampton Roads. Windsor Woods is a neighborhood that always comes to my mind. For a while, that was not considered a high-risk zone. Maybe little certain pockets of it were, but then Hurricane Matthew came through and did a lot of like devastation and flooding in that area, and now it has been remapped, and those folks are now considered in high-risk flood zones. And even if they had a low-risk flood zone policy, they would have had to have changed to a different policy once their home was remapped, or they didn't have flood insurance at all, and now they have to get flood insurance. And then it also means rate increases for policyholders at renewal. The goal is to go up like 20 to 25% year over year until the full risk rate is met. Buying and selling a property and allowing a policy to lapse can also trigger a rate change. So flood insurance through FEMA is not like your homeowner or your auto insurance, where if you forget to pay it and there's a lapse with your auto insurance, you can call them. I'm so sorry, I forgot to pay. Here's my payment information. You give it to them, you know, they restart your auto insurance, you're good to go. But with FEMA, if you allow a policy to lapse, there's no way of calling them and getting it reinstated. You have to get a completely new policy. So it's a new policy number, it's a whole new quote, and there's a really good likelihood that that premium will be higher than what your renewal rate would have been. Also, I get this question a lot for someone who is selling a home in a high-risk flood zone, and there's a flood insurance policy in place. Let's say it's like $700, and then the buyer purchasing the new home goes and gets a flood insurance quote, and it's coming in at like $1,200, and you know, keeping them from qualifying for their loan. They can assume the seller's policy. We do that all the time. We just have to, the parties have to agree to it, and we call the insurance company and, you know, make the change on the policy. But there are a couple things that we love to educate our customers on, and the lender and the agent, is number one, the flood insurance policy that's being assumed by the buyer from the seller, it doesn't like restart at closing. So let's say there's only 4 months left on the policy, then it's going to renew in 4 months. And there is also a chance that when it does renew, there will be an increase. Now, it's probably not going to increase up to that $1,200 that they were, you know, being quoted for a new policy, but it could increase by like 20 or 25%. So we just like to let them know that there could be a gap in the escrow. So they might want to just put some money away to, you know, fill the gap for that increase in the flood premium. All of this did have an effect on home values in the real estate industry, and will probably continue to do so. Homes in these high-risk flood zones are harder, you know, I think, to sell than homes that are not, especially if there's an expensive flood rate. So the impact, all policies increased rates. That includes the policies in the preferred risk zones. When I first got into the insurance business, you could get a preferred risk policy at the highest level of coverage between $350 and $400, and now it's $500. So I know like that's only $100, but it's gonna just continue to go up. Properties affected could drop in value in these high-risk flood zones, making it because they're harder to sell and turn over. FEMA added a $25 primary residence fee, like surcharge, to all flood insurance policies, including the preferred risk policies. And you have to show proof that it's your primary residence. So if you're purchasing the home, then you can just show your closing documentation. If you already live in the home, you have to show like 2 forms of ID. Because the reason they're so strict on that is if it is a second home, you know, like a vacation or a home that you're renting out, then instead of a $25 surcharge, it's $250 each year, which is a huge difference. So that's why they are so strict on the proof that it's your primary residence. So here are some ways that you can combat some expensive flood premiums. One of the easiest ways is add the correct square inches of flood vents to a home that is already sitting on a crawl space. That can dramatically lower a premium. I had an instance that I was working on a few years ago where a home in Chesapeake was on a crawl space, and I had the flood elevation certificate, did the quote, and the quote was coming back to at like $1,200 a year, which doesn't sound like a whole lot, but for the buyers, it was, because it was keeping them from qualifying for their loan. So after some back and forth with the flood insurance company, we determined that they didn't have the compliant amount of square inches of crawl space vents to the square feet of crawl space. So if you have 2,000 square feet of crawl space, they want like half of that, half and up to equaling of square inches of crawl space. So the sellers installed a few more flood vents. They had an engineer go out and redo the flood elevation certificate. And then when I did the quote with the updated square inches of flood vents, the premium literally fell by 50%. It went from $1,200 to $600 a year, and the buyers were able to qualify for their loans. And I learned recently from a gentleman that works at JES, I think is the name of the company, the crawl space company, that a flood vent, the engineered flood vents to install, it's $350 per vent. So that's how I always would get the question, how much does it cost? And I'm like, I don't know. So if you use JES, it is $350 per vent. It looks like I've got something in the chat. Regina, if I bought a home in high risk AV with insurance or anywhere, then next year the home is devastated from a flood, would the policy cover replacement at value when I bought the house? No. So with FEMA flood, the highest level of coverage they offer is $250,000 to rebuild your home. So that's what they would give you to rebuild your home if you were to, you know, have like a total loss, or, you know, a really big devastating loss. So $250,000 for the dwelling, the home itself. And then for your belongings inside, the highest level of coverage they have is $100,000. Does that answer your question? And I'm going to also touch on the private market here in a minute.
I was just thinking about the high rates. I was just thinking about the high rates of what people are buying now. And actually, I was looking at a house on the water, and that was a discussion I was having with my boyfriend, that the risks of it. So I was just thinking, would it be covered if it was devastated a year or two from now?
With FEMA, it's only, yeah, with FEMA, it's only $250,000. Now with the private market, and I'm going to touch on this in a minute, they do have higher, you can have higher coverage. So you can, you know, insure it for higher than $250,000.
Oh, okay.
Cause the premium, you know, to go up a little bit. I'll touch on that in a minute. Also, getting a LOMA, LOMA, that stands for Letter of Map Amendment. And that's typically issued because a property has been inadvertently mapped as being in a high-risk floodplain, but is actually sitting on like naturally high ground above the base flood elevation. So let's say that you get notification that you've been mapped into a high-risk flood zone, and now you need to get, flood insurance. And you're like, wait a minute, my home sits up high. There's never any water that comes anywhere near my home. Like this isn't right. You can contact FEMA, fill out this letter of map amendment, submit it to them. And what they'll do is they'll send someone out to like resurvey your property. And if they do determine that they made a mistake, then they will remap you back into that low risk flood zone. And then raising your home, that is something that is going on a lot in like the Norfolk area, in Larchmont or Lock Haven area. And a lot of times if you've experienced like repetitive flood loss or flood claims through FEMA, you can get a grant to raise your home, because it is, that's expensive to lift the home off the ground and get it higher. Definitely an initial expense up front, but as flood rates continue to rise, it will save you money in the long run. And like I said, if you're a property that has experienced repetitive flood loss, then you could qualify for a grant. There's also the built to code grandfathering, excuse me. So let's just say a flood insurance policy was in effect when the new flood map became effective and maintained continuous coverage, or the home was built in compliance with the flood insurance rate map in effect at the time of construction. So the results of grandfathering can provide cost savings to a property, an owner or a purchaser, when the new map takes effect. However, there will be cases when using the elevation certificate and rating with the new flood map could result in lower premiums than grandfathering. So both options should always be evaluated, and the agents at Prosper will definitely do that. We take an education and consultative approach. So we're going to evaluate all options. It's important to remember that if a building though has been substantially damaged or improved, it is not eligible to be grandfathered to the map that was in effect at the original construction date. Instead, the map that was in effect at the time of the improvement or the damage must be the one that is used. So that's like the one caveat there. And then get your clients to work with an insurance agency that understands flood insurance. Our agents at Prosper deal with flood insurance like day in and day out, and are extremely knowledgeable and can really, help guide you and your clients in the right direction, and get them a flood insurance policy and a premium that they feel good about. Okay, so when I first started this presentation, I mentioned that historically, private insurance companies did not cover flood insurance. However, in the last few years, the private insurance companies have, dipped their toe into the flood market, so to speak. And now private market flood is a viable alternative to purchasing a FEMA flood policy. Buyers who are purchasing or live in high-risk zones can purchase a private market flood policy and through the private insurer to satisfy their mortgage requirements. There's only 2 mortgage products that will not accept the private market flood or a policy from a private insurer, and that's FHA and USDA. Both of those are government-backed loan products. They want a government-backed flood insurance policy. However, VA, conventional, the other ones, they will accept the private market flood insurance policy. They very often have a lower premium than FEMA. And I can give some examples of that on this next slide. They have better coverage available. And here's the kicker, guys, an elevation certificate is not required. So if a home is newly mapped into a high-risk zone, if it's brand new construction and they don't have an elevation certificate yet, you can get a premium or a quote, a premium and a policy, all without an elevation certificate. They have a much better claims process because you're dealing with an insurance company and not the government. And if you're insured with Prosper, you'll have an even better claims experience because we have a whole claims advocacy department dedicated to helping our clients, with their claims. And over time, more options and competition will create benefits, i.e. lower premiums. So at Prosper, we work with a few different flood insurance policies, and they are Neptune, Dual, D-U-A-L, Johnson & Johnson, and Cat Cub. So we have multiple options to shop for private market flood insurance. And here's a little FEMA versus private little pictograph here. At Prosper, we do have the in-office certified FEMA flood experts. And so now some differences between FEMA and private. So separate other structures coverage. So if you have a detached shed or a detached garage on your property, through FEMA, you would not automatically get flood coverage for that detached structure. They only insure the dwelling, so the home itself and your belongings inside. If you had a really nice shed or a detached garage, a mother-in-law suite, what have you, if you wanted flood coverage for that separate structure through FEMA, you would have to purchase a completely separate policy. But through the private market, it automatically provides 20% of coverage from your dwelling, like the dwelling coverage, to any separate structures on your property. So you would not have to get a separate policy, which is huge if you have a really nice, like I said, garage, shed, or mother-in-law suite. The private market flood offers replacement cost coverage for your contents in the home. So with FEMA, you have coverage for your contents, but you have it at the depreciated or actual cash value. So if you experience a flood and you've got, a really nice rug that's like, $2,000, $3,000, you have a really expensive couch, FEMA is not going to refund you or replace the rug or couch for that, $2,000, $3,000, $4,000. They're going to give you the depreciated value of the rug and the couch. But with the private market, they will replace your $2,000 rug with another $2,000 rug. And then the private market offers limits over $250,000. So to your question, Regina, if $250,000 for flood coverage, most of the time is probably sufficient. But as you start to move into these higher value homes that are, $750,000 and above, and they're custom built, $250,000 probably isn't enough coverage to fully restore it after experiencing a devastating flood loss. So you can up that coverage, higher if they want like $500,000 or, $600,000 of coverage for the dwelling. They offer that and they can get it. So that way the buyer feels fully protected. Coverage is immediate. So right now with FEMA, if you want to purchase a policy, unless it's tied to a real estate transaction, then there's a 30-day waiting period before coverage goes into place. So you call FEMA now, you fund the policy, well, 30 days from now is when coverage will be available. But through the private market flood, coverage would be immediate as soon as you fund the policy. So that's huge. And then the last thing is
that true even like, let's say the hurricane season's here and I go purchase it?
Well, yes. However, now if there's a hurricane or a tropical storm, rolling up the coast, this is true for all insurance companies. They could set a moratorium to where you can't bind coverage, while the storm is making its way up the coast and here. That happens for home insurance too. So if there was, a tropical storm slated to hit on Wednesday, they would probably have a moratorium in place right now where you can't bind coverage.
Till after the storm. Okay.
Till after the storm, exactly. Good question. And then FEMA does not have, not FEMA, I'm sorry, the private market does not have that secondary home fee of $250, that surcharge if it's, a vacation or rental home. So a couple of instances on the premiums is one of our agents was quoting a home that had a finished mother-in-law suite, on the property, a detached mother-in-law suite on the property. And of course, the mortgage company was requiring flood coverage for the home and the detached mother-in-law suite. So the agent did a quote through FEMA. And remember, with FEMA, 2 separate policies would need to be purchased. So the total of the 2 separate policies through FEMA would have been $7,500 a year, $7,500, which the buyers were like, no, can't qualify with a $7,500 flood insurance premium. They quoted it through the private market, one policy with coverage that did extend to the mother-in-law suite. It was only $3,500, so it was $4,000 cheaper, and they were definitely able to qualify for their loan and close on the property. And then we had another instance where a buyer was purchasing a home that had a swimming pool, and with FEMA, if they wouldn't even cover a swimming pool. You can't even buy coverage for a swimming pool. So they wouldn't have even had it. And the policy would have been $3,500. But through the private market, they were able to get a policy that did provide swimming pool coverage, and it was only $1,800. And I'm sure a lot of you are like, well, this is a no-brainer. Why would you ever get a FEMA flood policy? Well, one, if it's FHA or USDA, you have to. You can't get private market flood, unfortunately. 2, there are going to be rare instances where maybe sometimes getting the private flood insurance could be more expensive than FEMA. Let's say, you're increasing the coverage higher from the $250,000. That's when, we like to educate our clients and let them know exactly what they're getting. We're always going to quote both, especially if there's an elevation certificate. We'll quote FEMA, we'll quote private. There might be folks who, especially if the private market flood insurance premium does end up being higher in a rare instance, the buyer still might want to go with that higher premium because they're getting replacement cost coverage for their contents. It's higher than $250,000, and they have coverage for their detached shed on their property. So they see the value in paying a little bit more to be adequately protected. Or you have, some folks that they're like, I don't care about the bells and whistles. I just want the lowest premium. And if FEMA is the way to go, then that's what I want to do. So like I said, we're going to quote and evaluate all of our options and present them to the buyer. That way they make the decision that they feel good about. And that's it, guys. That's the presentation. I have some resources up here if you want to check to see if a home is in a high-risk flood zone. You can go check out the maps at FEMA. If you're like me, those maps are a little hard to read and give you a headache. So always feel free to reach out to me. I've got my contact information right here on the screen. If you're unsure about a flood zone for a home, or would like to maybe get a potential quote or estimate, you can email the information to me and I'll have an agent work on it for you and get it over to you quickly. And
could you put your email in the chat, please?
Oh, sure. Let me do that right now. Thank you. I'm bringing everything up. I'm going to stop sharing. All right. Uh-oh, hold on one second. There you go. Any other questions?
Thank you.
All right,
Appreciate
well,
that. I'm actually
thank
going to
you
reach out
guys.
to you.
Yeah, you're welcome. Have a great day.
Thank you.
Thanks. Bye.